Hello and a good morning from New York and a good afternoon from Brussels. My name is Bart van Ark. I'm Chief Economist at the Conference Board, and welcome to our monthly Economics Watch, which this month we will be focusing on the global economy. As always, we of course also talk about the US economy at length, but as we just updated our global economic outlook, we thought that we would spend some time today to discuss some of the main issues with regard to our global economic outlook. It's been a mixed picture. We have actually seen some decently good numbers come in for the first quarter, but at the same time, when we're looking sort of out over the remainder of the year, our overall narrative is still that we're looking at a slowing global economy compared to what we saw last year. And then in addition to that, there's still significant risks out there. We're experiencing one right now when it comes to the trade negotiations and the uncertainty whether there will be a US-China trade deal, which is seriously impacting the markets in the past couple of days. And again, the question is, how is this going to impact the economy? So obviously talk a little bit about that today. We'll talk more generally also about the Chinese economy, again, showing somewhat better numbers in the first quarter, but still seems to be losing momentum. And we want to understand some of the reasons behind that. We talk about other emerging markets, including India, Brazil, and Mexico. And to what extent we can count on them to provide better growth numbers in the remainder of the year. We'll also talk about Europe extensively. Of course, Brexit is still hanging as a cloud above the outlook, not just for the UK, but also the potential impact that it may have on the euro area as a whole. And then finally, of course, as always, every month we'll talk about the US economy. Before I introduce the group that we have today with us, let me just explain to you a few guidelines to maximum benefit from this webcast. Of course, we'd like you to ask questions. This is an interactive webcast. Those of you who are attending regularly know this, so please use the chat box that's on your screen. Type in your questions anytime, and we will try to weigh them into the conversation one way or another. You can download the presentation, share it with your colleagues. You can toggle between the video view and full screen by clicking on the 4 arrows at the top of your screen. And also we'd like to remind you that there is a brief evaluation at the end, and this is always helpful for us because this is a way for us to figure out how we can continue to improve on providing this product to you. And then finally, of course, the webcast is available on demand shortly after this webcast on our website. Some of you may be joining us for earning credits. Today we do have CPE credits. That's if you're eligible for that. Just type in your full name and email address in the space provided. Click OK for free of the pop-ups that appear during the program. Stay online for the entire webcast, and of course you will only get those CPE credits if you enjoy the live webcast. Then finally, before we get started, we have a very good team today. It's basically our Global Outlook team. Here in the studio with me is Brian Shaitkin, a regular almost every month on this webcast. So for Brian, for you, this is a home game. But thank you for joining us on the global part of the story today.
Bart, looking forward to discussing whether we should expect continued momentum as we've seen since the shift in monetary policy, or have recent concerns about trade shifted the outlook.
Right,
we'll find out.
And you exactly identified two US-type topics that actually do influence on the rest of the global economy. And for that, we're benefiting from two of my colleagues in Europe, in Brussels. We have Ilaria Maselli, who is our senior economist for Europe, and joining us today to talk about the European outlook. Welcome, Ilaria.
Thank you, Bart. Hello, everyone. And I know everything about the royal baby, so I'm ready for the webcast.
Yes, we should definitely talk about the impact of the royal baby on the outlook for the UK economy, and hopefully it will help. So we hope we have some good news there. And then from the Netherlands is joining us Abdul Eramban. He's our senior economist for emerging markets, and is going to shed more light on what is happening on the rest of the world, everything outside Europe and the US. So it's a large group of countries to cover. Welcome, Abdul.
Thank you, Bart.
All right, so let's go right away first to sort of the global picture and sort of see where our overall narrative stands. But before we do that, we have two poll questions, because we always first want to hear what you are thinking about the global economy before we start to talk about it. So the poll question should now be appearing on your screen. And the first poll question that should be coming up is, in which region do you think the growth outlook has most improved since the beginning of 2019? So in which region do you think the outlook has most improved since the beginning of 2019? Is that the US? Is that Europe? Is that China? Is that emerging Asia? Is that the Middle East? Or is that Latin America? So please take your pick. Where do you think we have the biggest upside, if you like, compared to where we were at the beginning of this year in your view? And we give 5 more seconds. 5, 4, 3, 2, 1. Okay, good. So 2/3 of you on the webcast think this is the US. Now, I have to say that maybe there is a bit of an overrepresentation of US attendance on this webcast. So just want to make sure that we're not biased here, but it is of course true that the US economy, especially in the first quarter, as we'll talk about later, has improved relatively well. But then there are some of you who are saying that actually emerging markets, about a quarter of you say emerging Asia has actually been doing better, beyond China, that is. So that's a pretty good number also, and I'd like to hear from Abdul whether he agrees with that outlook that in the rest of Asia we see the upside. And there are just a few of you who think that Europe and China also surprised on the upside. Again, both of them had better first quarter numbers. We have a second poll question, and that is just the other side of it. In which region do you think the growth outlook has suffered most since the beginning of 2019? So where do you actually think there's a bit of a downside compared to where you were a while ago? So where do you see more downsides in your outlook? And again, we'll hear from you where you think the biggest downsides are observable. And we'll give it 5 more seconds. 5, 4, 3, 2, 1. And thank you for closing it. And now we find that just over half of you actually think that Europe is actually still performing on the downside. So we have relatively large pessimism with regard to Europe, and Ilaria will definitely want to speak about that in a bit more detail, because again, also Europe, actually the recent estimates are actually showing somewhat of an upside compared to where we were, but maybe from your perspective as an audience, you still feel it's more disappointing than what you had been hoping for. Other votes have been spread a little bit around the US, China, which 70% of you think has performed a little worse, also Latin America, 13%. So thank you. I think that's a good start, and not all that far away, frankly, from the way that we are looking at these things. And let me just give you quickly sort of our overall narrative and then show you a few numbers, and then we'll take a bit of a deep dive first in the emerging markets, then in Europe, and then in the United States. So overall, we're still seeing that the global economy, as we saw a couple of months ago, is going through a slower growth phase in the year 2019 compared to where we were in 2018. 16, 17, and 18 were all 3 pretty good years for the global economy. But by the end of 2018, we began to see significant weakening, and we projected that into 2019 to continue, basically because most countries are beginning to sort of converge gradually to a slower underlying trend. And that slower underlying trend is very much driven by slower growth in the labor force around the world, as well as slower productivity growth. As said, we had somewhat better numbers for the first quarter, including the US, China, and Europe, but it doesn't really prevent us from this pullback. We still believe that the overall number for 2019 globally will be about 2.8%, which is 0.3 percentage points down from what it was in 2018 when it was 3.1%. The slowdown is pretty widespread, as we'll see in the next chart just in a minute. And of course, as I mentioned, there are still these risks that we need to be concerned about. Brexit, the US-China conflict, they continue to rattle a lot of the confidence in whether we will stabilize in that slower growth path. And as I mentioned earlier, particularly in the last few days, we have seen how quickly just one tweet can upset the markets quite significantly. We may see a correction pretty soon, but it creates the kind of volatility and uncertainty in the economy that many of us worry about, and could down the road create sort of more substantial risks. Monetary policy, as Brian mentioned a little earlier, has become more supportive of the global economy by an overall outlook for lower inflation, no more significant tightening. There's been some tightening in the US in the last year, not likely to continue during this year, and that has overall been a supportive force. At the same time, labor markets remain tight. We have these unfavorable demographics when it comes to slower growth of the working age population. These two factors pretty much around the world drive up labor cost, potentially impact profits in going forward, and this could be one of those game changers so late in the global cycle. I mentioned the issue of productivity. I'll show you one slide just in a second. Our very latest outlook on productivity growth is still quite weak. We don't see digital transformation and innovation to translate itself into faster productivity growth yet. Maybe this is just a matter of time, which we tend to believe, but this has been a pretty long cycle in which we're beginning to see, or not yet seeing, those positive productivity effects going forward. So here's our outlook very quickly for 2019 as a whole. The blue bars is the outlook for 19. The orange dashes is the outlook for 2018. You can see the overall slowdown in the global economy, pretty much driven across all the mature economies. So despite some of the optimism with regard to the US, even the US is showing a significantly slower growth rate in 2019 than it does in 2018. This is true for the other emerging markets. This is true for China. This is true for India. This is true for other developing economies. The upsides we perhaps see in some parts of Latin America, like Brazil, for example, but Brazil's still sort of recovering from a very deep recession, and even in Latin America, it's a pretty mixed picture. So overall, we're still kind of in this slowdown mood, despite the recently good numbers in quarter one. And the real question, of course, is whether these real numbers in quarter one could perhaps make us a little bit more optimistic down the road. And for that, we need to look at some of our confidence numbers. Here we're looking at global consumer confidence. This is just our latest release. This is looking at global consumer confidence in 2019. So on the left-hand chart, you're actually looking here at the levels of optimism and pessimism in different parts of the world. This is a heat map, so the more orange, redder parts are where we have relatively optimistic consumers. That's particularly true for North America and for Asia. And the bluer parts are where we have the somewhat more pessimistic consumers. And that's true for parts of Europe, although it's a mixed picture in Europe. It's true for Russia, of course, for parts of Latin America, but again, a somewhat mixed picture. On the right-hand side, you see the change. And this is the change in consumer confidence in quarter one compared to quarter four of last year. And there you see that, for example, North America, South America, and China, large parts of Europe, still all see a pretty good strengthening in optimism, in consumer optimism, but there are downsides too. We see Russia, we see Turkey, some other countries that are seeing a slowdown. Globally, it's kind of a pretty mixed picture. It stays pretty much the same, but there are some upsides and some downsides that we can talk about a little more. And then finally, when it comes to forward-looking indicators, our leading economic index is worth looking at. This chart is looking at a combination of all our 13 leading economic indexes combined into the global leading economic index. And you can see how over the last sort of half year, almost a year, this index has gradually moved from a clear expansion signal to a slowdown signal. Still positive, but a slowdown signal. January, we saw it actually briefly go back into expansion territory, but in February it moved back into slowdown territory. And that means about 6 months looking out from the month for which we can measure this. It means that so from now until at least the fourth quarter of this year, we expect the global economy to continue in the slowdown mode. The difference between countries, for a long time we have seen the UK already in contraction territory. That doesn't mean that the UK economy is in contraction. It just means that the signal of the index, of the leading economic index, is showing as a recession signal. And that really means that as soon as we get more clarity around Brexit and it turns the wrong way, or it will be interpreted the wrong way by the business community or by the consumers, it might potentially push the UK economy into recession. Most of the other economies are sort of in between expansion and slowdown, gradually moving more towards slowdown away from expansion. So I think both consumer confidence and the leading economic index both seem to be pointing at this slowdown scenario that we are continuing to describe for the remainder of the year. And then finally, and before we move on to other regions, I will ask each of my colleagues to briefly comment on anything that has been said so far. Let's finally look at productivity growth. This is output per person employed growth. And you can see how since the mid-2000s, productivity growth globally has been slowing down. This has been pretty widespread. This is in mature and in emerging markets. We were a little bit hopeful that we were going to see some recovery here But frankly, if you look at the 2017 numbers, the 2018 number came even somewhat down, and our projection of 2019, we're still kind of in the 2% labor productivity growth territory, which is well below what we were seeing in the early 2000s, and makes us believe that this promise of productivity growth is still further out there and not something that we're seeing in the short term. So let me pause there for a moment. Brian, let me just ask you, is there any kind of comments that you have right now on the global picture?
I think this productivity chart is exactly what the business community should be focused on. Because if you look at the short-term outlook, the fact that there has been a slowdown from the last year or two is not surprising. Growth is a function of population growth and productivity growth. The population dynamics in most economies that we cover, even emerging economies, have become less favorable. So the question is, what is happening to productivity growth? And that's why there's been a lot of interest in the fact that over the past few quarters, the US is showing more evidence that productivity growth is rising that may reflect a shift in investment activity towards software, towards research development, and we'll see if those trends actually get confirmed.
Yeah, you're making a very important point indeed. The US numbers the last few quarters have actually been up somewhat. Those are numbers for the business sector, so that leave the government out. That's one thing that we should perhaps take account of. But still, it is an important signal, and it might perhaps translate itself to other parts of the global economy also. So maybe there's a little bit of light at the end of the tunnel here when it comes to productivity. Ilaria, any comments from you on sort of the global picture?
Yes, I actually want to stress on what Brian mentioned. So again, on this chart, this beautiful chart that we have on the long-term trends in productivity growth, because what I notice in conversations every day is that we're constantly bombarded with new information and a risk there, a risk here, news coming in affecting financial markets. So it's very hard to really think in terms of long-term developments of the economy about the structural dimension of growth. And at the end of the day, that's all that matters, much more than the daily tensions. So I'm happy we have this chart just to remind everyone that the structural elements are perhaps more important than the daily noise that we hear on
and frankly, that's the balance, right, that we're trying to find. On the one hand, we were just debating this before this webcast started. On the one hand, we're looking at these quarterly numbers, and they are important because they drive your numbers in your quarter. But at the same time, there is this underlying trend that really tells you what is it worth to make all these investments and efforts, and can we, what is the probability that we really can benefit from that down the road? So balancing the cyclical and the short-term issues versus the structural long-term issues is important. Abdul, let me finish with you. Any comments here, and then maybe we can also move on to the a little bit more detail for the emerging markets. You are a productivity expert, so you may actually have some comments on this chart too.
Indeed, this chart. I can also speak a lot about this chart, but our colleagues have already spoken a little bit about it. But I'm going to tell you something else actually, which I found is also important from the perspective of the global description which you were providing. In much of 2018, especially later part of 2018, we were seeing a lot of pessimism about the global economy, recession concerns, and especially in the emerging market, we were seeing a lot of challenges in terms of currency weakening and monetary tightening and all those aspects which we have been seeing. And that seems to be disappearing now, which is partly triggering some of the optimism now. And the bigger question, I think some of that will also be addressed in the coming slides, is that are we ready to be happy and cheer up with this easing of some of these major tensions and major issues which we have seen in the 2018? And I think relating to that part, I want to relate it to one of the poll questions where we found that some of the optimism is in the emerging Asia, which excludes China. And I think it resonates a little bit with some of these easing tensions and also some of the dynamics which is happening in some of the smaller economies like Vietnam, for example, because these economies are showing some resilience and some improvement. But the overall picture for the region, and its impact on the global economy seems to be a moderating effect on the global economic growth in the coming year.
Good. Yeah. So let's go a little bit more into some of the details on emerging markets, including emerging Asia. Let me just remind the audience again of putting in your questions anytime, because we can weave them into the conversation. So whether they relate to Europe or the US or emerging markets, just put them in whenever they're on your mind, and we'll take care of them. So Abdul, you already talked about optimism and how much optimism is there. So let's take a somewhat closer look at consumer confidence here. You're comparing here the light blue line, the level of consumer confidence in Q1 in 2019 compared to Q4. And what's the overall picture that you're beginning to see from these confidence levels? Big changes? Where do we see some big changes? How should we interpret this?
Yeah, so let me first start with the positive picture here, because what you see is that in this chart, 100 is generally considered to be an optimistic level of confidence, consumer confidence. So anything which goes above 100 is considered to be that they are becoming more and more optimistic. And if we go far below that, seems to be more pessimistic scenario. But what you see here is that this is a picture of all the emerging market economies in our sample. And I have at the extreme right-hand side, I have the emerging market average. And what you see is that overall emerging market seems to be on optimistic territory, and the consumer seems to be remaining strong in these markets. And this is particularly true in emerging Asian markets. And you can see that most of the countries on the right-hand side are emerging Asian economies, and also some economies in the Middle East and Latin America are also there. So what it says is that this is also resonating with the emerging Asian story, which I was saying earlier, that these markets consumers in these markets are extremely confident. And the point is that if that confidence translates into actual spending, that can trigger and that can positively impact their outlook. And we also have some countries on the left-hand side, which are countries like Russia, Ukraine, and Argentina, Venezuela, some of the troublesome countries in Latin America, and Turkey, for example. So these are countries where we do not see consumers still very optimistic. But the other point I wanted to make is that we also see an improvement in consumer confidence in several emerging Asian economies. And India, for example, even though it did not see a major improvement, seems to be one of the highest, most confident consumers after Philippines globally. So there is a lot of optimism in the emerging Asian markets here.
Right. So that's the good news. But then let's look a little bit at what the bad news is. And the bad news is that when we look at trade, there's actually quite a bit of contraction going on. So aren't we living in a world here when it comes to these emerging markets that sort of the domestic consumers feel that the economy is doing fine and we're doing all well from a consumption perspective, but at the same time, when it comes to the global picture and the way that companies are operating in this part of the world, they're facing these headwinds from slowing global trade.
Exactly. So this brings us to the negative news that global trade growth is trending down. Definitely, it has been happening for a while now, and this decline has been more dominant and prominent in emerging markets, which is depicted here by the red line. And you can see both in terms of exports and imports, emerging markets are doing really bad and contracting territory. So now coming back to your question on how we resonate it with the consumption holding up very well, consumers' confidence holding up very well, and at the same time trade is not happening. And part of the explanation lies in the fact that a lot of trade has been happening lately in intermediate goods, and perhaps I haven't looked into that dynamics, because we still do not have sufficient data to look into that dynamics, how the relationship between the distinction between intermediate trade and final goods trade is happening within this dynamics. But if that is the case, if intermediate goods trade is declining in this, and perhaps that would also figure out in some of the industrial production statistics, because that would imply that consumption of intermediate goods in some of these economies have actually.
So the point that you're making,
So
I think, is here that I think it's an important point that you're making here, that you say that a lot of this slowdown in trade may be related to slowdown in intermediate goods. This has to do with supply chains and everything else, rather than with the final goods, which is certainly when it comes to the imports, a better indicator of the consumer side. But on the other hand, of course, if you look at things like PMIs, this is the Purchasing Managers Index in manufacturing. There actually we see some countries being in expansion, some countries being softening. So when you look sort of from an industrial production point of view rather than just a trade side, the story tends to become a little bit more positive in many cases again.
Yeah, so that is a bit of a puzzle actually, because you see that in the PMI remains in optimistic territory and expansion territory in large emerging market economies like India, Brazil, and also China. It is after a decline in the previous months, it has shown some improvement, and the overall index also shows some uptick. But still, you see that large countries like India, Brazil, and also Mexico is showing a declining trend, even though it is still remaining in expansion territory. And in the next chart, where we look into the actual, I'm sorry, I don't have that chart here. But when we look into the actual industrial production growth, what we see is that we do not see an uptick in any of these markets. Actually, we see in fact a decline, and in some countries we even see a contraction in industrial production. So there seems to be some kind of optimism here, but within China, for example, where we see an improvement here in the PMI, the manufacturing export orders have been declining, and that we will see in a later chart, which basically see that the trade is going to definitely impact the manufacturing sector also in these economies if the global trade remains uncertain.
Right. So yeah, it's important to emphasize that these PMI indexes are in a way confidence indexes. This is what purchasing managers think it might look like in going forward. And maybe again, they are sort of driven by some optimism that, you know, this US-China trade conflict may work itself through, and therefore the outlook is better than what we're currently experiencing. So if you pull this together, Abdul, and put this all in our leading economic indexes, and on the left-hand side, you're comparing the emerging markets with the global economy, you still see that overall emerging markets just are more strongly expansionary still than what is true for the global economy. And on the right-hand side, you see that, again, China, which has come down for a long time in terms of its leading economic index, is now beginning to actually slow a fair bit. Or has actually had to come down quite a bit, is improving a fair bit. Sorry, I was misstating it.
Yeah, so that's a very important point you are making, that China has been showing a continuous weakening for a while now, and now it shows some uptick. And I will come to that point in a minute in the next slide, but let us talk about other countries here in this chart, because what is happening in China will be more clear when we really look into the underlying dynamics of some of the indicators which is driving that uptick in China. But to the headline story is that much of it is coming from real estate and consumer optimism. And the big question is that whether that can be sustained or not. So we will come to that in a minute. But if you look at other countries, India also sees some uptick in in overall leading economic index, and which I think is likely to suggest a sustained improvement in the short term in the coming months. Because historically, if you look at the performance of Indian economy, post-election months have shown an uptick in growth. And with a lot of stimulus packages announced by the government, which can lead to a lot of fiscal expansion in the country and trigger consumption, I think it is likely that it will enhance the economic outlook for India in the short term. But going forward in the later part of the year, that will ease out, primarily because of substantial fiscal challenges, because the government is now targeting 3.4% fiscal deficit, which is almost unrealistic and can happen only as a magic. Otherwise, it's going to be something near to 5%. The other biggest challenge is that unemployment has been at historic high level in India, so which is also a major challenge for India, in addition to all the external challenges which we are talking about other countries. So for Mexico, we see continuous weakening in the leading economic indicators, which is in the negative territory. It is too early to to consider a recession possibility there. But much of that has been driven by substantial policy uncertainty even after a new government in Mexico. So the only country where we see a recovery mode will continue is Brazil for now.
Right, and that's as I mentioned earlier, a lot of that is a recovery from a pretty deep recession and some upside that's been seen, particularly on the side of possible investment opportunities that are there. But again, a lot of that needs to be realized. But let's wrap up this section with the China thing that you referred to earlier, right? It was a pretty good number that we got actually for Q1 in terms of GDP growth, a little higher than was generally expected. But still, overall, we don't really think that this is going to be a major uptick in China compared to what we've been seeing. This slowdown that we've been seeing in the last few years is likely to continue in the remainder of the year. So why is that?
Yeah, so there are a couple of reasons. First of all, the recent uptick is driven a lot by government stimulus. And you can see that on the right-hand chart that much of that growth expansion has been maintained by consumer growth, but also some net export improvement. And that is, rather than an uptick in export growth, it was a decline in import growth, which triggered that growth uptick. Or growth stabilization in China. But now if you look at the left-hand chart, where we have the different components which contributed to the uptick in the China's outlook or the leading economic indicator growth, what you see is that, as I said earlier, a lot of it is coming from consumer expectations. And so in China, perhaps consumers are maintaining a belief that government stimulus and government intervention would help the economy, and that may be triggering the consumer expectations. And the bigger question is that if that would translate into increased consumer spending. The other aspect is that the real estate investment activities, which is triggering some of the optimism in China. Again, because of the stimulus, investment in the real estate has been increasing, while that is not happening in the manufacturing sector, in fact. So the challenge is that this is not what the Chinese government or the Chinese policymakers are also anticipating, but somehow this is what is happening and triggering the current uptick in China. So that is less sustainable. The other important point which I wanted to make here is that the profit outlook, which is I think highlighted here by the red bar, is actually shrinking and it is declining, which is also a big challenge for companies, and that can also hamper further investment activities in China. So the overall narrative is that in going forward, there is very little to expect that this growth momentum will sustain, and an uptick in growth will be seen in China in the
and in many ways it's kind of a managed slowdown, right? I mean, if the Chinese economy slows down too much, the government will just step up a little bit more in terms of making sure that investment growth can continue. There are tax cuts that help the consumer side of the economy. So it remains a managed slowdown. This uptick in the first quarter is an upside, a much needed upside, frankly, because the trade dispute is weighing pretty heavily on the Chinese economy. So I think the hope that that this first quarter may help a little bit in terms of moving things forward for the rest of the year is actually very welcome news. Brian, let me ask you, any questions, comments on the emerging markets outlook from your side?
I guess I have a question about this fundamental assumption that the Chinese fiscal expansion is not something that can be sustained in the event that economic growth from the private sector ends up being slower than anticipated. Couldn't the Chinese government, given its debt to GDP position, and given couldn't the government simply choose for time to continue to build up infrastructure and do the types of investment activities that would help the economy's productivity capacity continue to increase on a long-term basis? Why is that not possible?
I would say, Brian, that actually goes back to where we started this webcast, and that was slowing productivity growth. If there's one country where we see huge slowdown in productivity growth, it is in China. And some of that is because the catching up potential that China had in the early 2000s just going to go away. If a country becomes more mature, it's harder to continue to grow your productivity. But the other part of it, if growth is being driven by allocations of money from the government in trying to channel to prop up the economy for state-owned enterprises, of which we know they're not the most efficient in the economy and the most productive in the economy, and therefore crowds out potential growth performance in other parts of the economy, private or semi-private. Nothing is really private in China when it comes to the business sector. I think this is exactly what is happening here. So you can do this, but it's what we economists call diminishing returns. At some point, you just can't continue to do this. Can we do this for the remainder of the year? Yeah. Can we do it another year? Yeah. But will, as a result, the Chinese economy gradually continue to slow down? Yes, and it's all due to slower productivity growth. Ilaria, any questions on your side?
Not really, but it's so interesting that I'm
okay.
Just following.
All right, so let's then move right now that we have you on the line and have you stop throwing paper at us. We can actually move into Europe's outlook because actually the China outlook is relevant for Europe. Europe is highly dependent on China. And maybe some of the uptick that we've been seeing in China has been helpful for Europe. And frankly, as I mentioned earlier, when we looked at some of the recent Europe numbers in Q1, Europe now comes out with a flash estimate, so we by this time know a few numbers for Europe already. It actually turns out that the first quarter has performed better than the last quarter of 2018.
Exactly, Bart. So let me start with a sort of overview of what happened in the last quarters. So at the end of 2018 and the very beginning of 2018, the outlook was looking quite concerning, honestly. And in a way, I'm going to repeat a little bit the same things as Abdul, because as you said, the two economies are very much connected with each other. So at the beginning of the year, what was very concerning is that both on the trade and business side and on the consumption side, there was quite a heavy feeling of pessimism. And this was also reflected in our C-Suite Challenge survey, where there was an important share of CEOs that thought that the biggest risk for this year was going to be a recession. Then what happened? Well, one thing, if you can, I have to ask you to move the slides because I lost the connection on my iPad. So I have to ask you to move to the next slide. So what happened is that consumer confidence started to improve. So there was a change that we observed during the quarter. And so right now, consumer confidence is a bit higher. It increased again. Of course, when you look at euro area, the average, you have to understand what's behind the average. And not all countries are equally optimistic, as you can see on the left-hand side of the chart. But I'll just try to give some the main numbers. So as I said, euro area as a whole improved in the first quarter of 2018, according to our global consumer confidence index. If you look inside, if you unpack the euro area, you can see that confidence in Germany is quite high. It remained rather stable, I would say, but on very high levels. So consumers in Germany are happy. Less happy are the Italian consumers, and rightly so, because the economy entered into a recession during the last quarter of 2018 and the first quarter of 2019. The last two quarters of 2018. Now, in the middle somewhere, France and Spain, and it's interesting to observe that in France, consumer confidence increased a bit, and this was clearly a rebound from the negative feeling around the Gilets jaunes, the yellow vest protests. Now, I think beside the daily news, as I was saying before, there is an important thing that is fueling the optimism in consumers in Europe, and that's the labor market. The labor market is doing really well, and you can see that both on employment and unemployment numbers. So unemployment came down to 7.7%, and so as you can see on the blue line of this chart, it kept going down very regularly, and it still is continuing. And at the same time, employment and labor force participation have been increasing. So we clearly have an aging problem in Europe, but this has been somewhat compensated by the fact that especially the 50-plus workers are participating more and more into the labor market. So this is giving some relief also to the problem of
So
labor
it seems
shortages.
that, like in Asia, consumers are pulling us through. Again, they may be somewhat less optimistic than in Asia, but still, in some countries, high levels of optimism. Like in the case of France, we have seen an improvement in optimism. But at the same time, when we look now at industrial numbers, and here again are the PMIs, the Purchasing Managers' Indexes for manufacturing, they don't look very good for Europe. And even though some people believe we passed through the industrial cycle in terms of its slowdown, these numbers are not yet showing us a convincing rebound, do they?
Definitely. So indeed, the story is a bit the same as the one Abdul was saying. On the consumer side, I think we're doing quite fine. And so the domestic demand in Europe, I wouldn't be worried on the domestic demand front, but definitely on the external demand. So the chart that Abdul showed before with the decline in global trade, of course, is reflected also in the PMI numbers for Europe, where most economies are important exporters. And you can see there that the very latest figures show a little bit of an uptick, but compared to the longer downward trend of the last month, it's actually quite small. And it's still 1 month only, so there's nothing we can derive from that. I think really the important fact there is the downward trend of the past months, and this is fully justified by a number of factors. First of all, the slowdown in China, which is very important, of course, for the European economy. The overall decline in global trade is another one. And then, of course, there is a part related to the uncertainties related to the trade tensions and Brexit, and so that plays. On top of the structural issues related to less trade in intermediate input and Brexit, which is becoming a structural issue because it's been going on for a long time. There is also the news that are not helping. So yes, the decline in the PMI is quite serious. There is a little bit of positive news from the data, and that's the fact that, it's not an easy situation to manage for producers and especially for exporters, but there's been a stop in the growth of wages in Q4, which provides a little bit of relief to companies as they have to manage this slowdown.
Right. So let's talk a little bit about the UK, as we frequently do. To your earlier comment, is it the B of baby or the B of Brexit that is dominating the story for the UK?
So in the chart that you see there, it's definitely Brexit. But hopefully, in the next consumer confidence release, we can talk about the royal baby a little bit more. It's too fresh news to be captured in the data, I think. But we're joking, but not too much at the end of the day, because I think there was an uptick in consumer confidence at the time of the wedding of Meghan and Harry. So I wouldn't underestimate the impact of these events for the British economy, especially as people in the UK are sick of hearing Brexit for breakfast, lunch, and dinner. So I'm sure they're happy to hear something else in these days in the news. Now, going back to serious, to the important things. What's the situation? So on the Brexit front, on the negotiation front, it looks less and less likely that Labour and Conservative parties will come to an agreement. This means that there will be European elections in the UK. This is, I would say, almost certain by now. There will be European elections on the 26th of May, and then they will start participating in the European Parliament. Now, of course, the next important deadline after the elections is the 31st of October, which is, in a way, again, the cutoff point whereby if nothing happens, if this parliament, if it's still there, in 6 months, doesn't find a majority, then there will be an exit again without a deal. So the chances of a no deal are still there. We should not forget this, but the situation keeps being as confused as it has been for the past 2 years and a half.
And frankly, given the fact that the 31st of October is it's not too long and it's not too short, it's kind of right in the middle. Certainly, the European elections might very well lead to an outcome that we have a lot of votes going towards a hard Brexit. In fact, a lot of people very upset about it may actually vote through the elections for a big exit. So in a way, the ways you're describing it, might very well increase the chance that a hard Brexit could happen down the road. So that's Ilaria. Let's wrap this up for Europe. Here's your kind of final slide. What are some of the more important assumptions that we need to look at for the euro area outlook for the remainder of this year?
So yes, I'll try to summarize quickly. So I think the most important thing to keep in mind, and if you have to keep in mind one number out of the entire Europe section of this this webcast, the important thing is that basically what we expect in terms of growth for the euro area is that we reach the medium-term capacity of the economy, which is something that we argued more than a year ago already when things were going super well and there was a big party going on for the economy here. But we thought this would not be sustainable, that the capacity of the economy wouldn't be able to keep up with 2.3%. And indeed, what we expect now is 1.3%, which is in line with what we expect for the next decade, which is 1.4. So we are basically at the medium-term growth perspectives. So that's the important figure, I would say. Now, looking inside the countries, we expect Germany is doing a little bit better, and that's because some of these temporary issues that had to do with the low level of the Rhine and the standards for the cars. So all these temporary issues that came together at the end of last year now are gone. So only the structural issues are there. Then Italy, we expect the economy to recover a little bit, but all in all, the economy is not doing well below the average for the euro area. And then one thing on the UK, we forecasted during this year when we calculated our numbers, we forecasted a small recession during 2018, such that the overall estimate for 2018 is 0.8. Yeah. So these are the main numbers. On the UK, just one thing, and then I will conclude. The important thing is in the previous chart, and that's the fact that productivity growth is doing worse than the euro area, than the European average and other mature economies. And this is very much connected to another slide and another figure that we showed in past webcasts, and that's the fact that investment has been subdued since the Brexit referendum, because I mean, that's in a way, when you want to understand what uncertainty means, I think that's a very important figure to look at. Yeah. The fact that investment has been weak.
So overall, it's still a mixed picture, right? I mean, we have these somewhat stronger European numbers, but then when we look at sort of an overall summary, it's still like a little pluses and a little minuses, and it's another signal where we started this webcast of a gradual slowdown with a bit of differences between countries towards this sort of slower growth trend. So let's move on to the last section, Brian. We kind of deliberately left, I wouldn't say the best, but at least the most optimistic to the end of our webcast, because we saw that in our earlier poll that people really were positively surprised about the European numbers, about the US numbers, I'm sorry. But even here, when I look at your headline for our US outlook, I mean, they're kind of two stories, right? Yes, there was a good first quarter number, but it doesn't take us away from this sort of slower trend growth that the economy is gradually converging towards.
I think it's a challenge to keep these two stories in our heads as we think about the US economy. On the one hand, the growth that occurred over the past 2 years, in 2017 and 2018, particularly in the middle of 2018 when growth was nearly 4%, is simply unsustainable. A lot of it's based on fiscal stimulus, both tax cuts and increased government spending. Those policies, I mean, the tax cuts will remain in place, but they're not going to be added. There aren't going to be new tax cuts going forward, and that government spending we do expect to fade out in 2019. So the expectation that we have is for growth to fade out towards its medium-term trend of 2% and to indeed be just above that number for the rest of this year and into 2020. So that is a slowdown, yes, but it's still a relatively good economic performance, especially this late in the economic cycle. Now, there's also the short-term story. Growth surprised on the upside in the first quarter at 3.2%. Earlier in the quarter, there were fears that growth might be well below 2% because of the government shutdown, because there were concerns that interest rates would continue increasing during the year and that might harm consumption and investment activities. A lot of those fears have been eased. It's important to keep in mind, though, that first quarter growth was in part based on temporary and unsustainable factors. Inventories continued to be built up at a rapid pace, and we'll talk more about that in a moment. Import growth was negative, so that also contributed to growth. And so when you look at the more sustainable aspects of growth, consumption and investment, those actually were underwhelming in the first quarter. But I think on the consumption side, I would expect good news to be ahead. The labor market is simply too strong. 3.6% unemployment, first time in half a century that the US has reached those levels, and wage growth continues to be strong. Until this past week, in general, sentiment was improving. Stock markets regained previous record highs. But of course, with some concern about the future of China trade negotiations due to administration policy announcements during the past week, and some concerns about where exactly this week's summit is going to leave us in terms of a future agreement. It's introducing uncertainty into the business climate. And I think one other thing to keep in mind is that the investment story is not quite as sanguine a story, simply because you have an environment characterized by increased costs on the labor side, low inflation. That low inflation will help continue this easing monetary policy for some time, but it also means that businesses simply can't get their price points. And so that's going to be a drag on profits. That could potentially mean somewhat less investment growth. And indeed, as we've been seeing in the other regions, the manufacturing dynamics in the US also aren't quite as strong. Manufacturing, particularly car sales, has been off a little bit.
So if you sort of decompose this a little bit in the chart here, you can begin to see your story, right? If you look just at the bar just before where the blue part starts, which is the forecast, you can see how much the blue part, which is the consumption, has been pulled back, and also the consumption part was pulled back. So those are the sort of longer term things we really need to care about that really were on the downside in the first quarter, but then we were positively surprised by these transitory factors. And going forward, you do see that consumption and investment are beginning to pull us back into decent growth territory, but not enough to pull the growth rate up. That's basically your story.
Yes, that's correct. So you can see on this chart that the gray area, net exports, and the purple area, inventories, contributed a large portion to that first quarter growth. Those factors are going to be pulling down growth for the rest of the year. But as Bart correctly mentioned, the green part, investment, and even more importantly, consumption activity, that's going to be providing a more positive influence on growth for the rest of the year, and should, as long as labor markets remain strong. Another way of looking at this is to think about GDP growth, and then this second line, the red line, final sales to private domestic purchasers, which is a fancy way of saying consumption plus investment. Mm-hmm. And you can see that over the last few quarters, growth in that consumption plus investment line has been declining, but we do expect that to improve, both because of the labor market dynamics supporting consumption, the fact that you have lower interest rates that could support the housing market and support other investment activities. Still, the profit environment gives some concern for business investment, but overall we expect that those elements to make a larger contribution, growing near at or nearly 3% through 2020, whereas GDP growth is going to be just above 2% during that period.
So these inventories, they're very volatile. We talked about that before, but obviously that's been surprising us. So can you take a little bit of a deeper dive in what is happening to these inventories and why that was such a big contribution in quarter one?
So I think it's important to remember that growth was very rapid in Q2 and Q3. As a result, businesses began producing
During Q3 of last year.
Yes,
Yeah.
producing more goods and services. And so that helped lead to increased retail and wholesale inventories. And you could see this chart presents the inventory to sales ratio. And what that is indicating is that these ratios have been reaching higher levels due to continued firm inventory builds. But they're not at alarming points. We've seen these ratios be higher at other points during the cycle. And so it's not as if firms are in a position where they have to destock rapidly and cut production in a way that would create recessionary risk. Simply by tailing off production gradually over the next few quarters, which is what our forecast calls for, they can keep these inventory to sales ratios in a normal range.
So the other big question then is the labor market, right? And we have this strong labor market, we have this strong wage growth. It still held up reasonably well in the last quarter, not as well as some people have perhaps expected. But the big question is, we have this low inflation. So somehow businesses are not passing on these wage increases to consumers, because otherwise we would have seen inflation go up. So why does that not happen?
I think it's a structural story, and it's a global story. The fact is that there is increased price comparability as e-commerce rises. There are also horizontally integrated competitors who have been achieving spectacular cost savings for many, many years now. Those companies have a lot of market share. And so, building up market share is as much of a concern for many of those companies as building up profitability. So at the end of the day, when labor costs increase, it's easier to take a brief hit on the bottom line than it is to pass those costs on to consumers. And so the end result is that the link between wage and price dynamics is not as clear.
But that would mean that profits will have to go down at some point, right? And do we expect that for this year?
Yes. I mean, I think I'm not sure profits will go down. We're in a strong enough growth environment that's not clear they will go down. But certainly you're not going to see the type of profit growth that you saw in previous years. And I think when you look at what's been happening in the market, you see those dynamics reflected where yes, equity prices, the red line, have increased during the year and have gotten back to record highs. But I think there's also a recognition of this is as good as it gets given these price dynamics, given these wage dynamics, considering that growth is likely to settle at or above 2%. And so I wouldn't expect equity prices to rise much higher. And we're going to talk more about profits next month.
Right.
And I think there's a lot of concern right now that profitability can't really grow all that much in the type of competitive environment that exists, and given how tight labor markets
Indeed,
are.
next month, Brian, you will be back together with Gad Lebanon, our Chief Economist for North America, to actually go much more deeply in this topic, but here was a little prelude of the view. The other thing, of course, here important is that, yes, we have seen these big declines in the stock market in the red bar, in the red line here, coming down, but still very high levels that were up, right? I mean, we're still sort of at the top of the level where we were in October. We've just made a huge amount of recovery in the first few months of the year. So let's see where this is going to go until by the end of the week, when we hopefully know a little bit more about where this trade dispute is ending up. Let's wrap up. Finally, we have 1 or 2 minutes left with major insights in the chart. I want to make sure that I get one question in that was here a little earlier, and that is the investment line, and whether the investment line also takes account of investment from foreign companies in the United States. Has that become more important as a part of the overall story?
So investment into the U.S. is definitely taken into account. I mean, that goes into purchases of equipment, for example. So that is definitely taken into account for sure. We have seen a general weakening in terms of some of that equipment investment, in terms of a measure of capital goods, new orders. That growth has slowed down. So I think those capital inflows have probably slowed down for the time being.
But still, you show a pretty good number for the remainder
Yes.
of this year when it comes to non-residential investment, which includes the equipment numbers here, right?
Right, but a
6%,
lot of that
5.4%.
is a result of what we call intellectual property products, research and development software, and that's very important in terms of thinking about your productivity story, and that's where we've seen an awful lot of growth, and if that continues, that certainly bodes well for the productivity outlook and being able to sustain this.
But just to wrap up on the top line here, still, I mean, as you said, I mean, quarter one is a surprisingly good quarter, but still we see pretty large slowdown in Q2. We're now 1 month into Q2. I mean, are April numbers, to the extent that we're seeing those, are they pointing in the direction that the economy is slowing significantly compared to where we were in quarter one? I guess hard to see, because a lot of the quarter one numbers, as you explained, are these transitory factors like exports and net exports and inventories.
Yeah, I think you're not going to see in some of the core releases because they deal mostly with questions of consumption and investment.
Right. And they will pick up.
Employment has continued to remain strong. But I think it's simply based on where inventory levels are, and given that you're likely to see increased purchasing activity, which will also drive down inventories, that trend is not going to continue and boost growth going forward.
More of this next month, because next month indeed we are going to talk in quite a bit more detail around profits, inflation, wages and earnings, focus on the US. So Brian, you'll be back together with Gad Lebanon. Let me also point you to our portfolio of content around the global economic outlook. Some of the reports are our original outlook of last November, but we just released our latest update, which we talked about today. There's a document which I've written myself, Straight Talk, that goes into quite a bit of detail on the update of the outlook and some of the matters that we've been discussing here. Brian, thank you very much. Ilaria, thanks for joining us from Brussels, and Abdul from the Netherlands, good to have you on, and to take this sort of quick tour of 1 hour around the world. So that's much appreciated. Please take care of some other activities that are taking place at the conference board. You can find it on our website, and don't forget the brief survey at the end. And with that, we're finishing our monthly economics watch and hope to see you again next month. My name is Bart van Ark at the conference board.